Welcome viewers. In this video, we will discuss about the multiple choice questions related to the topic monetary policy. We will also discuss the options with explanation so that we'll solve other MCQs related to the topic that we will discuss at here. Now let us start the first question. Which of the following steps a central bank can take to motivate investment in a country? That means here the question is related to the motivation of the investment. Central bank wants to motivate the investment of the country. Let us look at the options. The first option is increase in the cash reserve ratio. Option B, increase the bank rate. Option C, sell the government securities in the open market. And option D, reduce the cash reserve ratio. Here I will pause for a few seconds so that you can think about the answer. Well, the answer is D. If the cash reserve ratio increases, the commercial banks have to keep larger share of their deposit uh, with the RBI and they cannot circulate it to the public. So, lesser amount of cash will be in the hands of the commercial banks that can be circulated to the economy. So, definitely the investment of that country or of that economy will decrease. Second option is increase the bank rate. Bank rate is what? Bank rate is the rate at which commercial banks can take loan from the RBI. Now in this case, if the interest rate goes up, then definitely commercial banks have to pay larger amount as the interest to the RBI. So definitely again it will reduce the available amount of money with the commercial banks that they can circulate to the public or to the economy. So again it will go against the investment motivation for the economy or for the country. Third one is the selling the government securities in the open market. Now, when government sell the securities like bonds in the open market, then definitely people will buy it. And if people are buying the bonds that is circulated by the government, they will have lesser money in their hands for the investment. So it will also decrease the investment capacity of the people in the country. So option A, B and C are incorrect. Then we left with the option D. Let us check that whether option D is correct. So option D is telling the reducing the cash reserve ratio. That means commercial banks need to keep lesser amount of money with the RBI. So they will have more amount of money with them that they can use for giving the loan to the public. If people are taking loans from the bank, they can invest that money in different projects, so it will increase the investment motivation of the country. So option D is the right option. Let us move to the next question. Which of the following steps a central bank will take to increase the overall availability of credit? Means how much money is available for an economy to the credit purpose. Let us check. First option, buy government securities from the market. Second option, increase the reverse repo rate. Third option, increase the repo rate. And fourth option, sell the government securities in the market. Here I will pause for a few seconds so that you can think about the answer. Well, here is the answer, the first one. Now look at the other options. Option B, increase the reverse repo rate. Now reverse repo rate is the rate at what RBI can take loan from the commercial banks, or in other words we can say that commercial banks, if they give some amount to the RBI, then RBI will pay an interest rate. Now whenever the commercial banks are giving the money to the RBI, it is quite certain that RBI will not fail to give the interest rate. On the other hand, if the commercial banks are giving that money to the public, it can happen that the public can be the defaulter of that loan. So, if the reverse repo increases, then definitely commercial banks will prefer to park their money with RBI. So, in that case, definitely it will decrease the overall availability of the credit of the society or of the economy. Option C is increase the repo rate. What is repo rate? Repo rate is the amount of money that commercial banks give to RBI when they are taking loan against some securities. Now, if the increase repo rate happens, then definitely commercial banks have to give larger share of the money that they are receiving to the RBI. So, lesser amount of money will be available for creating the credit to the public. So, overall availability of the credit will decline. Option D, sell the government securities. Now, government sells the security. In the previous question also we have seen that definitely the people will buy the securities, buy the government bonds, then they will have lesser amount of money for the investment and all. So it will also decrease the availability of the credit. So option A is the correct one when government buy the securities from the market. So government is buying means government is giving the money to the public. Right? Government is giving that money to the public and public is selling that bonds or government securities to the government. So option A is the correct option. Next question. What are the main functions of central bank in a country? Option A. Responsible for the regulation of money supply in the market. Yes, central bank, or here in the case of India, RBI is responsible for the regulation of the money supply in the market. Option B, responsible for issuance of notes within the country. Yes, RBI also issues the notes within the country, means in India. Option C, acts as a banker of both government and other banks in the country. Option C is also correct. So, option D is saying that all of the above. All of the above are correct. Yes, all of the above means all the options A, B, C are the functions of the central bank in a country. So let us look at the answer. Answer is the option D. Now we will move to the next question. Which of the following statements is true for RBI? First option, it regulates the entire banking system. It is the issuer of currency notes. Option C, it is the Apex Bank of India. Option D, all of the above. Here I will pause for a few seconds. Remember, this question is quite related to the previous question. So you think about, or you can go back and look at the options that is given in the question number 3. And think about the answer for the question number 4. Let us look at the answer. Answer is option D. Yes, it regulates, RBI regulates the interbanking system. RBI also issue the currency notes. RBI is also the Apex Bank of India. So option D is the correct option or the answer. Let us move to the next question. What will happen if central bank sells securities in the market? Option A, credit creation capacity of the commercial bank will rise. Credit creation capacity of commercial banks remain unchanged. Credit creation capacity of commercial banks may rise and credit creation capacity of commercial banks will fall. Here I will pause for a few seconds. Think about the answer. We already discussed another question which is quite related with this question number 5. Here the correct option is credit creation capacity of the commercial bank will fall. We already told that if central bank sells the securities, then people will have lesser money, right? Lesser money, or the banks will also buy some of the securities of the government. So banks, commercial banks will also have lesser money for the credit creation. So credit creation capacities of the commercial bank will fall. Now in this case option A is not correct because it is just telling the opposite. Credit creation capacity of commercial banks remains unchanged. No, commercial banks will definitely buy some of the securities that will be offered by the central bank. Option C is telling that may rise. This is also the incorrect option. So option D is the right one. Let us move to the next question. What will happen to the lending capacity of the commercial banks as central bank reduces the cash reserve ratio? We know that the cash reserve ratio is nothing but the amount that the commercial banks have to keep with the RBI, right? To keep with RBI, and it is a percentage of the deposits that it is receiving from the public. So here let us check that what are the options. First one, the lending capacity will decrease. Second option, the lending capacity may increase or decrease. That means indecisive, right? This second option is basically not giving any clear picture regarding the change or regarding the lending capacity of the commercial bank. Third option is there is no effect. Definitely there will be effect. So option C is also not considerable. Option D, lending capacity will increase. So in that case, basically we need to focus on option A and option D, which is clearly telling us about the impact on the lending capacity of the commercial bank. So here I will pause for a few seconds so that you can think about the answer. Right option is option D. As we know that if commercial banks need to put less money, need to keep less money of their deposits amount with the RBI, then definitely they will have more money to lend it out to the public. So option D will be the correct option. Let us move to the next question. Identify the accurate picture if the central bank of the country increases the reverse repo rate. Reverse repo rate we already discussed. The reverse repo rate is the rate at which commercial banks can give money to RBI. So in this case, the demand for goods and services in the country will increase. First option. Second option is the demand for goods and services in the country may increase or decrease, means again indecisiveness in the second option. So we can ignore that. Third one, there is no effect on the demand for goods and services in the country. And the fourth one, the demand for goods and services in the country will decrease. Here I will pause for a few seconds so that you can think about the answer. Option D. Option D will be the answer, because if reverse repo rate will increase, then definitely commercial banks will prefer to park the money, some amount of money with the RBI, and they will ensure that they will definitely get the certain amount of return from the RBI. Now in this case, lesser amount of money then will be available with the commercial banks to lend it out to the economy, and lesser will be the investment. If lesser will be the investment, then definitely lesser will be the production. Lesser will be the production means lesser will be the demand for the goods and services. So demand for goods and services will decrease. This is the right option. Let us move to the next question. Identify the accurate picture if central bank of a country increases the repo rate. We already discussed what is repo rate. Repo rate is the rate at which commercial banks can get loan from the RBI or from the central bank. So in that case, if they are taking the loan at a high rate of interest, then definitely they will have lesser money. The money supply will decrease. Let us see whether this option is available among the given options. Yes, that is available at our option D, that money supply in the country will decrease. So this is the right answer in this case. See, here I have not discussed much about the options because already we have discussed the options in the previous questions. Let us move to the next question. Which of the following is not the function of the central bank of a country? Now here, let us check the first two options. First two options are being the custodian of foreign exchange reserves and accepting the deposits from the public. What is written? That both options, see that both the options are correct. Definitely both the options are not correct. Why? Because option B, that is telling accepting deposits from the public, definitely RBI doesn't take, or the central bank doesn't take the deposits from the public. We cannot deposit our money to the central bank, right? So option C is not the correct. Let us see option D. Both the options are incorrect. We need to check that whether option A is also correct. Being the custodian of the foreign exchange reserves, yes. RBI or central bank is the custodian of foreign exchange reserves. So option D will be the correct. Which agency regulates the money supply in India? Options are the Government of India, commercial banks, Finance Minister, and Reserve Bank of India. Here I will pause for a few seconds so that you can think about the answer. Right answer is Reserve Bank of India. So central bank basically regulates the money supply of any country, and in our case means in the case of India, the central bank is nothing but RBI. So RBI is the agency which regulates the money supply for India. Let us move to the next question. Which of the following statement is true about money supply? So we need to identify the correct statement. Let us check the statements. Option A. It is the total volume of money that is held by the government in a country. Option B. It is the total volume of money that is held by the public of a country over a time period. Over a time period means time to time. So definitely money supply is a concept, is a constant stock, right? It's not a flow. So definitely option B is not correct. Option B is not correct because it is telling about that what is the total amount of money from time to time or over time. So option B is incorrect. Let us look at option C. It is the total volume of money that is determined by the rate of interest on a regular basis. Now we know that money supply doesn't depend on the rate of interest because it is exogenously determined. It is determined by the central bank. So option C also we can discard. Let us look at option D. It is the total volume of money that is held by the public of a country at a particular point of time. So how much money the public is holding? Total volume of money. This is option D. Now here I will pause for a few seconds, and as I have given the clue, you need to think about option A and option D and need to find out the right answer. Yes, option A is the correct. It is the total volume of money that is held by the public. Let us move to the next question. Repo rate means option A, rate offered by banks to their premium customers. Definitely banks do not decide the repo rate, right? Commercial banks, and definitely not for their customers. So option A is not the correct. Option B, rate at which RBI offers loan facilities to commercial banks against government securities with the condition that banks need to repurchase the securities in a short period. Option C, banks can discount bills of exchange and avoid loan from RBI at times when cash is needed. Option D, banks having excess cash can buy securities from RBI with the condition of reselling securities to RBI on a prefixed day and price. Here I will pause for a few seconds and think about the answer. We already have discussed multiple times about the repo rate in the previous questions. So if you need to recall that, you can go back and then try to give the answer for this question. Yes, the right answer is option B. The rate at which RBI offers loan. RBI basically offers loan to the commercial banks, and commercial banks, if they need the cash, they can take the loan from the RBI. But here one thing you always remember, that the securities, government securities are required to take that loan. Okay, for the case of repo rate. So this is the option B is the right option or our answer. Let us move to the next question. An increase in cash reserve ratio by the RBI will result in, we know what is cash reserve ratio. So let us look at the options. Initially increase the supply, but later on decrease automatically. No impact on the supply of money in the economy. Increase the supply of money in the economy, decrease the supply of money in the economy. So here I will pause for a few seconds so that you can think about the answer. Remember, we already discussed about the cash reserve ratio. Yes, the answer is D. Because if cash reserve ratio is increased, definitely commercial banks will have lesser amount of money in their hands to create the credit. So it will decrease the supply of money in the economy. Let us move to the next question. Which among these is not a monetary tool? What are the monetary tools? Let us check the options, that among these which are coming under the concept of monetary tool. First one is SLR, statutory liquidity ratio, SLR. Second option is open market operations. Yes, this is also coming under monetary tool. CRR, that is cash reserve ratio. Yes, this is also coming under the monetary policy. And deficit financing. Deficit financing is not actually coming under the monetary policy. So the first three options are basically coming under the tools, monetary tools, to formulate the monetary policy. So in this case, the correct option would be option D, because we are asked that which is not a monetary tool. So deficit financing is not a monetary tool. Let us look at the next question. HDFC Bank is an example of, the options are foreign bank, public bank, none of this are private bank. I will pause for a few seconds so that you can think about the answer. And yes, you are correct. It is a private bank, right? So let us move to the next question. Bank does not give loan against which of the options are basically then coming under the securities, means people can use these as a securities when they can take the loans from the commercial banks. Let us check the options. Number one, gold ornaments. Yes, we know that gold loans are available in the economy. So against gold ornaments, people can take loan. So option A is not satisfying. So it is not correct. Option B is LIC policy. Yes, against LIC policy also we can take loans. Option D, that is NSE. Yes, against NSE also in certain conditions we can take the loans. Let us look at the option D. Option D is saying lottery ticket. Lottery ticket is something which is very much uncertain. We don't know that whether we will at all win that particular lottery prize. So uncertainty is there. We cannot consider it as an asset, the lottery ticket. So definitely banks will not give the loan against the lottery ticket. Let us check what is the answer. The correct answer, the correct option is C. So answer here is C. Let us move to the next question. Question number 18. Which among the following is also known as base money or high-powered money or reserved money? Options are MO, M1, M2 and M4. The right answer is A, M0. M0 or MO, it is called also the high-powered money or base money. Now let us move to the next question. Which among the following is not a part of liquidity adjustment facility? Now liquidity adjustment facility of monetary policy is the tool that basically regulate the liquidity of the economy. The tools can include repo rate, reverse repo rate, okay, that are used by the central banks to manage short-term liquidity in the financial system. So here the options are repo rate, reverse repo rate. Yes, obviously these two are coming. Then marginal standing facility and the open market operations. Here I will pause for a few seconds so that you can think about the answer. And the answer is D. Open market operations. Open market operations are basically it's not coming under the liquidity adjustment facility. It is regulated by the government when government brings the securities, government securities in the market, so it can stabilize the economy. Which of the following is not a function of money? Now we know what are the functions of money. Functions of money are medium of exchange, store of value and unit of account. So you think about the answer, and here I will pause for a few seconds. Yes, the right option is D, because all A, B, C are the function of money. Only the price stability is not coming under the function of money. It's coming under the monetary policy. So let us move to the next question. Which of the following are the function or functions of RBI? First one, banker of the government. Second, issuer of currency notes. Third, custodian of foreign exchange reserves. And fourth one, all of the options are correct. Here I will pause for a few seconds because all the options already I have discussed, so you think about the answer. Yes, the answer is D, because all the options A, B and C are correct. Now we will move to the next question. Identify the qualitative method of credit control taken by the RBI. Options are bank rate, open market operation, cash reserve ratio and moral suasion. Here I will stop for a few seconds. Yes, the answer is D, option D. See, bank rate is the rate at which RBI gives loan to the commercial banks. It's a fixed rate, right? So this is coming under the quantitative method. Open market operation is also coming under the quantitative method, and the cash reserve ratio means the ratio that the commercial banks have to maintain with the RBI. That is also fixed and determined by the RBI, a number. So it is coming under the quantitative method of credit control. Only moral suasion is basically what that when the commercial banks are not performing according to the RBI or doing some malpractices, then from the perspective of morality, RBI takes some actions. That is coming under the moral suasion. So it is a qualitative control method taken by the RBI. So the right option is the option D. Let us move to the next question. Which is not a money market instrument? Options are certificate of deposit, commercial paper, treasury bill and equity shares. Here I will pause for a few seconds so that you can think about the answer. And the answer is here. Answer is option D. Remember, the certificate of deposits, commercial papers, treasury bills, all these are coming under the money market instruments. But equity shares is coming under the security market. That's why we chosen the option D as the answer, because here it is asked that which is not a money market instrument, right? So equity shares is not included in the money market instrument. Next question is question number 24. What is the meaning of narrow money supply? Options are M1, M2, M1 minus M2 and M1 plus M2. Here I will pause for a few seconds. Yes, the answer is M1 plus M2. These are basically narrow money supply of the economy. Let us move to the next question. If the money supply decreases, what happens in the money market? Means what will happen to the money market if the money supply is decreasing or money supply decreased? That means money supply is lesser than the money demand. Money demand is more. That means excess demand of money will be there. Excess demand of money supply means it will definitely uh, affect the interest rate. People who need that money badly, they will be ready to pay higher interest rate to get that money, right? So in this case, let us look at the options. The interest rate falls, the interest rate doesn't change, transaction demand for money rises, the interest rate rises. Now here I will pause for a few seconds. I have already given the hints, so you try to find out the answer. Yes, the right answer is the interest rate will increase, because those who will need that money badly, they will definitely will be ready to pay higher interest rate. Now let us move to the next question. An economy is facing moderate output growth, means output growth is moderate, but significantly high in inflation rate, means price level is increasing badly, right? So in that case, if the output is not growing at the same rate of the increase in the price level, that means people would like to get the same output at a higher price, right? So in this case, definitely central bank should take some measure so that the money in the hands of the people will be decreased. So let us check the options. Decrease the income tax rate. If income tax rate decreases, definitely money in the hands of the people will increase. So it is going against the objective of RBI. Second option, decrease the cash reserve ratio. Again, it will increase the money supply because the availability of credit will increase. Option C, purchase government bonds in the open market. Now, if government purchases the bonds or buy the bonds, then again people will get more money in their hands. So, again it is going against the objective of the particular case what we are discussing here. Option D, decrease the money supply. Yes, money supply will be decreased. So, the answer will be decrease the money supply. Let us move to the next question. A commercial bank is an institute that provides services. What are the services? Let's check the options. First, accepting deposits, yes. Second one, providing loans, yes. So both A and B are correct. So option C is the right answer. So yes, option C is the answer. This is the correct option. Let us move to the next question. The objective of the Monetary Policy Committee is to control which one? Options are unemployment, option B, inflation, option C, economic growth, option D, trade. Here I will pause for a few seconds so that you can think about the answer. Yes, the right option is inflation. The economic growth or unemployment, these are coming under the fiscal policy. Trade, that is coming under the trade policies. Only inflation, that is coming under the objective of the monetary policy. So monetary policy committee will control the inflation of an economy. Let us move to the next question. Dash allows the RBI to absorb liquidity deposits from commercial banks without giving government securities in return to the bank. What are the options? Margin deposit facility, liquidity adjustment facility, variable reverse repo, and standing deposit facility. Here, all other options more or less we have discussed. Only the last option, that standing deposit facility, I need to give an idea about it. It is basically not widely recognized instrument, and in the particularly in the context of the central banking and monetary policy. However, it is quite related with the marginal standing facility. So this is a hint. This is a hint only. You try to think about the answer. Yes, the correct answer is the standing deposit facility, or we can say that the marginal standing facility. This is the correct option through which RBI can absorb the liquidity from the commercial banks. And it also does not include the government securities, because if the liquidity adjustment facility we say, then repo rate, yes, repo rate includes the government securities. When the RBI gives loan to the commercial banks, it ensures that the commercial banks keep the government securities with the RBI and should repurchase in future, right? So let us move to the next question. 30. The main objective of CRR and SLR are to ensure, here we have given three statements. Number one, liquidity position of the commercial bank, financial position of the commercial bank, profit position of the commercial bank. See, liquidity position of the commercial bank, that is the objective of the central bank to control through the CRR or SLR. Now, how the commercial bank will perform, the financial position of the commercial bank will depend on the commercial bank's performance, its strategy itself, its business strategies, right? And profit position is also depend on the commercial bank's performance, their business types, their business strategies, on all these things. Statement 2 and 3 are not correct. So in that case, let us look at the options. Only one is correct. Option B, only 2 is correct. Option 3, only 3 is correct. And option D, all the options are correct. Here I will pause for a few seconds. Think about the answer. Yes, you are right. Only option 1 is the correct. So we have discussed 30 questions on monetary policy. In future also we will discuss further about other MCQs which are particularly important for the competitive exams or the people who are doing specializations in finance. For them it will be very much helpful. So stay with us, and if you have any question you can write in the comment box. Thank you very much for watching this video.